Thanks everyone for joining us for our Next Ripple Ventures Tank Talk with Samir Kaji, Senior Managing Director at First Republic Bank, to discuss breaking through the crowd as an emerging manager. Thanks for joining us in the tank today, Samir.
Matt, thanks for having me on. I really appreciate it.
Now, just a brief background on Samir. As I mentioned, he is a Senior Managing Director at First Republic Bank, where he's been for the last 8 years, where he leads the VC and tech banking efforts with a particular focus on the early stage venture market, primarily emerging venture managers and seed and Series A startups. Prior to that, he spent 13 years at Silicon Valley Bank, where he held various roles starting out as an analyst all the way to an associate and VP, and eventually made his way to managing director in the Menlo office. He completed over $5 billion in debt transactions with 500 plus companies and firms. Let's kick things off and discuss about your operator journey at Silicon Valley Bank. You spent 13 years working with various capacities, providing capital, venture, and non-venture backed software companies with capital at all stages. Over the time that you spent there, what were some of the biggest mistakes you saw startups make after taking on venture debt that you would advise founders today to consider?
So I had a really interesting time in my career when I first started. It was 99, so it was the height of the dot-com bubble. And, startups were raising money hand over fist. Companies were going public in 18 months, and taking on debt financing to accelerate that was something that most companies were doing. And I actually did a lot of deals in 99 and early 2000. The bubble obviously popped in 2000. And, what happened is a lot of those companies that had taken on debt had this anchor that was really hard to solve for. It's hard enough to raise rounds when the equity market's tighten. It's even harder to raise equity when you have a large slug of debt associated with your company. And so there's a lot of things that I see. I think, for the record, I think venture debt and debt financing in general can be a great way to amplify returns in a non-dilutive way. Now, there are three mistakes that I often see, and I often saw companies make. The first is conflating debt with equity. The two are very, very different. Debt lenders want to get paid back, and generally speaking, they underwrite to a risk level at the early stages of 2 to 5% loss rates. That means they are going to call you when your cash is low. They are the top of the priority stack when it comes to any type of distribution, right? So you have to understand that these are two different instruments, and taking on debt is a responsibility that you should take at the appropriate time when you have visibility as a company. The second is not caring who your lender is. And, there are so many horror stories of companies taking money in the past from lenders. They gave them the best rates, but weren't the best wartime lenders. And when times got really tough, either they pulled the money, or what they did is call the founder every single day trying to figure out when that next round was going to come, or figuring out how to actually get their money back. And as a founder, when you're going through those times, you really want to focus on, how do I build a business? How do I get to that next milestone? And, spend my time actually fundraising from equity funders that can get me to the next stage of development. And then the third one is just taking on too much debt. I've seen companies raise 10 million and take $6 million in debt. You have to be really careful of over leveraging, because what fundamentally happens is when you take on too much debt, you end up in a scenario where a large part of your monthly burn is for principal and interest payments. You don't want that. I generally counsel companies to take no more than about 30% of their last round into debt. And what I'm speaking to is traditional venture debt. That's term loan financing, not your recurring revenue lines or AR lines, which I think you can have much more flexibility. But those are the three main things that I've seen.
Yeah, it's really important to hear you say that, especially for founders out there who are raising, $10 to $20 million Series A's right now. You should be looking at your venture debt partners the same scrutiny as you are with your lead equity investors, and focusing on the details really matters. Just looking at the interest rate is not the only thing that matters. It's also, in that wartime scenario, are they going to call it back? What are the penalties for early termination? We've seen a lot of term sheets come through, and there's a lot of gotcha clauses in there that a founder just has never experienced, especially if they haven't come from the traditional banking or finance world. What are some of those gotcha things that you definitely think people should just make sure they're aware of?
The biggest thing when you're looking at taking on debt is you're looking at the financial covenants, and you're also looking at, does the bank or lender have any subjective clause that allows them to call back the money? That's usually in the form of something called the material adverse change, the MAC clause. Most banks have actually gone away from that for competitive reasons, and they've morphed to something called investor abandonment, which basically means if your investors are no longer going to put more money and they're no longer supportive, the bank or the lender, which could be a venture debt fund, can pull back the money. Now, fortunately, we've gotten to a place where the market is efficient enough where the terms are actually very company friendly and founder friendly. But, to the extent that you don't know the lender, you don't know how they're going to act, you have to make sure you understand the terms and read through the loan agreement, which includes a whole set of provisions that are set in place to protect the lender.
Yeah, absolutely. It's kind of like taking a lower valuation on an equity round with a great partner versus taking a high percentage interest charge, but with better covenants and better terms for you as a founder. They kind of go hand in hand. And you shouldn't just look at maximizing valuation and lowering interest payments as the only things that matter. So I'm glad you really shared those with us. So after Silicon Valley Bank, you moved over to First Republic Bank, where you are now. And in 2012, you joined them along with some of your SVB colleagues to service the growing startup VC and PE ecosystem. What made you want to join FRB, and why did you want to have a particular focus on the early stage venture landscape, primarily micro VC and seed and Series A startups?
Well, first of all, I had an incredible experience at SVB. I started my career there, was there for 13 years, worked for startups for 10 years. And from 2009 to 2012, worked with venture firms. And when I started working with venture funds, it was the height of the global financial crisis. And in 2009, very little money was actually flowing into venture funds. I think it was close to 17 billion in the US, mainly soaked up by a small group of funds. And concurrent with that, we had seen the massive drop of the cost of starting a company, maybe not scaling, but certainly starting a company. And we saw this widening gap between angel money and Series A money because there was less Series A funders out there. And we started to see the first generation of what we would call now micro VCs or seed funders. Because I had worked with founders for most of my life, I gravitated toward people that were starting things. And actually, a lot of the people that were starting these small funds they felt like founders. They were, building, they were out there fundraising, they were building a team and brands. And a lot of them actually had come from operating roles. And so I gravitated toward it. So part of it was selfish because I really liked the people that were doing it. And I also just felt like there was going to be a shift in paradigm in venture as a whole, away from this monolith of every firm looking the same to one that was much more fragmented across stage, sector, geography. And so I decided I really wanted to build. My dad was an entrepreneur. When I was 15, I started my own baseball card business. And, First Republic is an incredibly entrepreneurial organization, and one that at the time was fairly nascent when it came to banking early stage funds and banking early stage companies. So I saw it as an opportunity to build something really interesting around the next generation.
That's exciting. Yeah, it's interesting to hear you say how you saw this sort of dislocation between the industry in 2009. I felt that personally when I was raising money for my company as well early on. And there was this huge gap in the market and how the capital efficiency of building businesses started to change. That started to allow more entrants into the market who maybe didn't have access to that $17 billion of capital that some of the traditional Series A and B later stage firms had. They now were able to come into the market and benefit with the companies that they were investing as well. Now, question: did you hold on to that Ken Griffey rookie card?
You mean the Upper Deck one? It was yeah. the one of my best. The first baseball card pack I bought of the '89 Upper Deck was actually Ken Griffey Jr. I unfortunately sold that because I was a card dealer, and in some ways I got lucky because baseball cards, as you know, have gone down in value, especially the ones in the 90s and 2000s. But I still have a few. I still have my Joe Montana rookie.
That's awesome. That's great. Well, I'd love to discuss our topic today, which is breaking through the crowd as an emerging manager. So you've discussed, how firms should exhibit a true differentiation around some type of moat rather than just being geographically or stage focused as a firm. How should emerging managers think about defining their moat so that institutional LPs can see the firm's differentiators amongst competitors?
Yeah, and I've made the comment, I think, on Twitter that I don't think having just a geographic or a stage focus is in itself a moat. I think that those are short-term arbitrages that if you are successful and your thesis is right, there will be other entrants that take away that short-term arbitrage. Now, at the end of the day, I always look at managers and say, if you're trying to create a competitive moat, you have to look through two lenses. Number one is, from the lens of sourcing, picking, and winning, are you exceptional at one of those? Do you have a great sourcing channel that in some way, while I won't say proprietary, but is a higher quality than the vast majority. Now the bar is really high for that, right? So it's not like, hey, I'm going to YC and I get invites to YC and therefore, I have great deal flow. That's not a sourcing advantage. Picking and winning, do you have some level of domain expertise around something? Do you have a brand around something? And does that allow you in some way to either win deals more consistently or see those deals, or at least go through a process where you can win those deals in a way without having to pay higher valuations? And then I look at, the background of the manager. Like, does it align with what you're saying your moat is? For example, Matt, if you told me that you were going after, let's call it enterprise startups in a particular industry, and then I look at your background and you've done that for 2 years, it's very hard to make the claim that you have a differentiated advantage for the thesis you're going after, because there doesn't appear to be manager moat fit. And, from my perspective, you have to have some advantage over, one element of the investing cycle, and also have a background that really fits into that, or at least shown in the past you've done things that would evidence that you really have a competitive advantage.
Yeah, that makes perfect sense. And it's great insight, manager moat fit. If I had, no deep tech background, but I was going after, quantum computing startups, that would definitely not align. But would you say that having, one defining moat is the only thing that matters? Because it sounds like you should have a couple of things that you're really good at and maybe one thing that you're great at, but you can't just do it with one great thing and the rest of them are just average. So, differentiators like due diligence and deal sourcing and your venture platform and brand, they've all started to sound really important to institutional LPs altogether.
Yeah, I mean, they're hard to differentiate on, right? So it's hard to differentiate and say, I have a better ability to diligence companies, or I have the ability, to look in the future and decide what the trends are. I mean, those are really hard things to actually do. And you're correct in the sense that you can't just do one thing really well and expect it to be, your, ticket to, outsized returns time and time again. Now, if your thing is really, 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 really good, then it's, the other things may not have to be as strong. But fundamentally, look, I mean, as an institutional LP, you're looking at everything. You're looking at, is this manager going to be a good fiduciary? Do they understand how to build a long-term franchise? Are they self-aware? Have they identified their let's call it GP moat fit? And do they understand the actual craft of venture capital? And that goes into things like, as you mentioned, due diligence, portfolio construction, understanding how to make decisions in a consistent way, having conviction. And these are all things that I think are very hard to say I'm differentiated at. It's more table stakes that you need to show a institutional VC that you understand, and then be very clear what your edge is. I don't know if you play blackjack, but when I used to be able to go places, I love blackjack because, it's the math behind it. It's the probabilities. And what you know about blackjack is the house has tilted it in a way that it slightly wins. And it's not, like 80%, win rate for the house. It's usually about 54%. And then if you know how to play, you can tilt the odds a little bit more toward your favor. And if you count cards, from a mathematical standpoint, you can even tilt it a little bit further. What an LP is really looking at is, what is your version of tilting that probability of outsized returns at a pace and at a scale that is different from the other folks out there?
Yeah, it sounds like a mixture of quantitative and qualitative. You can't have just one or the other. They really need to go hand in hand, and just how to tilt the odds in your favor are what people are betting on. So, let's talk about those bets, because over the last decade, the emerging manager ecosystem has gone from infancy to early maturity, with over 1,000 firms having been formed since 2009. Now, 85% of new firms formed over the last 5 years have been seed firms. Based on all the research and data you've reviewed, where are we in this cycle for funds formed in the last 5 years? And do you anticipate the bull market to continue?
So there's the macro question. And the macro question is, do we see any type of pullback in the capital markets? If you asked me back in March and April, I would say, yeah, Matt, of course. I mean, we're entering into a pandemic. Of course, things are going to stop. LPs are going to stop investing in illiquid assets. And that was when the public markets in the US had gone down 35% in a month. Now, fast forward to today, we've had a massive infusion of capital into the markets through fiscal and monetary policy. We have yields and interest rates at effectively all-time lows. And I don't see that changing. And I also see that, technology itself has accelerated through the pandemic. People are understanding that. And at the end of the day, I think that because of the low interest rates, where there's no place to put capital, and the understanding of the role of technology in our lives, I'm seeing much more capital being interested in investing in private assets. Venture is one of the few places you can get real alpha. Now, of course, you have to invest in the top 10 to 20% of firms and companies, but the return model is very different. So I don't think we're anywhere near a stoppage of it. In fact, within the seed stage market, I underestimated this at one point, but it's very clear people are comfortable raising small proof of concept funds to get off the ground. I see a massive opportunity for venture to be much more, and it's a fancy term that everyone uses, democratized. And I do think that we could live in a world where more people are investing in funds, more people are investing in companies, and the archetype of the funder, and let's call it VC in this case, is going to look a lot different. We talk about DEI efforts and underrepresented managers. I think there's a huge opportunity there for us to have much more diverse capital onto founder cap tables. So my view is with things like rolling funds and the ability to raise a fund with a little bit less friction than before, we are going to enter into a market where we continue to see new managers. Now, some will fall off, right? So some will not raise a fund 2 or fund 3, but I think those will be easily replaced by new entrants into the market.
Yeah, absolutely. I mean, I totally agree. The macro situation has basically presented where every day you wake up, the dollars you had yesterday are worth less the next day. And you need to figure out ways to earn more money tomorrow so that you don't lose that value as, the governments are continuing to pour more and more fuel on the fire. And technology is the only area where really that growth is happening at a tremendous scale to outpace that, devaluing of the dollars you have today. But also the capital efficiency in these businesses is starting to grow at astronomical rates. 80 plus margins for these businesses is incredible. And I think that capital efficiency is also starting to play itself out into the investing efficiency in these micro funds. You can really get ownership and invest in good quality companies that have been bootstrapped way longer than they typically had been before. We're finding companies in our fund that have, several million, if not, 5 million of ARR, and they've been completely bootstrapped. It's incredible to see that happening today. And I think the cost of capital, agree, is helping them, but also the capital efficiency in these entrepreneurs and wanting to build their businesses properly the right way versus the way that money was being poured on things maybe the last time around is definitely something that is trickling its way through the building and also the investing side of things. Wouldn't you agree?
I totally agree. I totally agree with that. And, I was smiling a little bit when you were saying that because it's exactly, what we talk about internally here. And again, I don't think it changes for a while.
No, absolutely. So let's talk about getting that money and the art of pitching. With regards to pitch deck building, you've discussed how firms should add in monthly growth of revenues of portfolio companies in their deck. Are there any other unique slides that you've come across as a non-traditional that you recommend all managers should start including to differentiate themselves from the herd?
It's a really tough question. Now, in the example about revenue growth of your portfolio, there's a caveat there. And the caveat is that you have to be investing in similar type of companies. If you're investing in commerce and SaaS in the same portfolio, it really doesn't make sense, and it's not going to codify in a way that makes any real type of value. At the end of the day, I don't know that there's any hacks to like, hey, you need to put something in here that's non-traditional. The issue I see with a lot of decks, however, is they're not very clear on what the zone of genius is. And if you know the concept of zone of genius, it's really the intersection of passion and skill set. And I always look at these things and say, okay, well, for example, if you're saying that you have the ability to get into these companies because of your value add, but there's no real systematize of the value add. Like, what does it actually mean? I love to think about venture capital and venture capital funds as a product. And your product ultimately is not the capital. It is a necessary thing that you need to bring to the table. However, your real product is, what does a founder get when they walk into the door? They put you on their cap table. What is that experience? That's your real product. And so I find too many people don't really get into what their product is. I see a lot about what the market is, what the thesis is, why they think they're differentiated. They talk about due diligence and all stuff that's really, really hard to differentiate about. But I want to know, what is your product? Like, why is an entrepreneur going to take your money consistently? And as an LP, can I draw the distinction between what you're saying and what is real in a very tangible way? And so I always tell people, understand who you are, make sure you understand what your product is, and spending enough time in the deck talking about your product.
Yeah, it's like separating luck versus skill. Are you lucky that the company's, hit a pandemic and there was a huge tailwind that happened in growing their business 10x in the last 6 months? Maybe you made that bet, but you didn't think it was going to happen that quickly. So maybe differentiate that. And also, it's interesting to hear you say, money binds the relationship as a partnership between the VC and the founders. But what are you doing to enhance that relationship after the money has already gone through? Because, you're stuck with these companies for 10 years. You want to show the investors that you are building a true value approach to the companies you're investing in. And if you can show that in your deck, that's really important. And we do that with our investments that we make even before we invest and also after we invest. We call it the ripple effect. How do we go from where the company was before we invested and where it is now, and what tangible things did we actually add in terms of value to get them to that next level? But being very clear that there's luck involved and then there's skill involved as well. So that's a really good point that you make there. Now, interesting on monthly updates. We provide monthly updates on our fund. Not everybody does. Some people do quarterly or annual. So how often should emerging managers have catch-ups with prospective institutional LPs? And what do you recommend GPs discuss in these calls besides fund performance? And do you suggest it to be monthly, quarterly? And if so, what do you recommend should be included?
At minimum, for sure, quarterly, right? I mean, you're sending out your quarterly financials, likely a letter to your LPs, articulating what actually is happening in the portfolio, your view on the market. For the bigger LPs, it's a relationship business. You are not going to be able to do it with every single LP, and the reality is you're going to treat a $5 million LP very differently than a $100,000 LP. That's just the state of the game. But for the bigger ones that are tight relationships that you expect to be long-term backers of you, and you're going to create, hopefully a lot of value for them, be transparent. I mean, I've talked to so many people and they see these reports that come through and it's just all sunshine and roses. And, venture doesn't work like that. Companies don't work like that. It's good to have rose-colored lens and be optimistic, but I like investors, and I personally invest every now and then. And I've gotten letters where VCs were actually very clear on what did they see as potential headwinds for some of the portfolio companies, how they viewed the market, their evolution in thinking. I always think about the market changes really dynamically, and managers that are really self-aware and understand, hey, we need to evolve. I've seen some great letters that include, hey, this is where we thought we were. Here's where the market's gone. Here's how we're thinking about things now. Here's the tailwinds at our back and why we, now think this thesis makes sense for us to pursue. And here's how we're doing it, right? So having those type of things, I feel like I have much more of an understanding of what the manager is thinking versus just telling me that these 3 companies got their Series A. That's great. I can see that. But tell me more. I want to get into your head of how you're thinking and evolving as a fund manager and as a firm.
Yeah, I mean, it's the same thing we tell our founders. When we set out with our first fund, we said we were going to do monthly updates, and my LPs called me crazy. But I was like, but we're asking our founders to give us monthly updates. And so why shouldn't I be able to give that information directly to the LPs, who are the investors to begin with? And, our founders, we asked them to be very transparent with us on the good and the bad. And we're going to do the same thing to our LPs. Now, we were told we were being too transparent with some of the information we were giving about the companies. And so we kind of pulled that back a little bit. But in our quarterly updates, we actually do a ranking of like kind of health of green being good, orange being sort of medium, and red, there's some troubles ahead for the company, and explaining that to investors. And that could change. Obviously, with startups, they changed very quickly. But we want to be transparent, because all of a sudden, it's like a company that's doing great, all of a sudden saying, hey, we're out of money next week. Can you give us an investment for $10 million? Like, last week was great. What happened? So right. I think it's about both being transparent on the investing side and on the company side as well. It goes both ways.
I agree with that. And the other thing I would just say is, there's a lot of vanity metrics that can be used. And this is more of a don't do this. If it's 6 months into your fund and you're giving me IRR numbers and touting those, it means nothing. It really, really does mean nothing. So stray away from, over highlighting the vanity metrics. Really focus on the business itself. Tell me how your business is doing.
Yeah, we've actually gotten some, in this COVID world, gotten some CEOs to just do a quick 5-minute video recording call with us. And then we put that together and share it with our LPs as well, so they can hear it from the horse's mouth on how they're feeling about the business before and future into the next year. So those are some interesting things that we've tried. We often hear about VCs pattern recognition, but we rarely hear much about the LP LP side of pattern recognition. So what are some common traits of strong emerging managers that you've associated with your own pattern recognition in helping them and the LP side?
So this is a really meaty question for a couple of reasons. And I want to start off with the term pattern recognition. I do think it's important, but it needs to be evolutionary. I mean, pattern recognition is just a fancy word of your own internal algorithms based on your experiences. The problem is if they're unchecked, we create these biases that actually prevent us from seeing things that are different. And we get locked into a certain archetype and saying, this is what a great VC looks like based on past performance. And I think that boxes out a lot of people that look and feel different. When LPs get too dogmatic about their LP pattern recognition, don't, recheck it, don't evaluate it constantly, don't challenge it. You're going to be passing up on so many great, talented managers that just look different, that feel different, that act different. And it's really, really important for LPs to understand that. So, from my perspective, the answer I'm going to give you on the GP side is similar. It's number one, it's self-awareness, understanding what you're really good at, what you know and what you don't know. I like some of the best managers and folks that I consider mentors have always said, hey, I don't need to be the smartest person in the room, but I want to be the most curious and most intellectually curious. I always want to learn. It's almost this insatiable thirst to constantly challenge their own assumptions, which then plays into their ability to evolve their pattern recognition. What was true before doesn't mean it's going to be true now. And, I had a great conversation with Roger Ehrenberg, who started IA Ventures, 11 years ago. And Roger, for those that don't know, you has run one of the most successful firms from a performance standpoint with multiple, 5X funds rather. It was very clear from my conversation with him, he's very self-aware. Who he is, who he's not. He understands the importance of constantly challenging your own assumptions, and then fundamentally thinking about your fund as a business. Right, you are not just raising a fund at a point in time, but you are building these relationships with your LPs. You are building a company that you want to have persistence in for a very, very long time. And when you do that, you start to make decisions with the long term in mind. So, I forget who told me this, but they said, hey, we're not focused on the size of the first fund because we're short term focused, long term greedy. And I really like that because what she was telling me, and I do remember now, and what she was telling me is that they were making decisions about their firm and how they operated as a partnership based on a 30-year bond. And when I talk to people, it's easy for me to understand how they're thinking about it. Like here and now, this is just the fund. I'm selling you a fund versus I'm selling you a thesis and a company that's built to last.
Yeah, that makes perfect sense. And maybe it's not even pattern recognition from a GP LP perspective. It's really pattern matching. You should have the same curiosity about the GP you're talking to as the LP as the GP has about you. And if someone were to say, hey, look, I'm looking to invest with a fund for the next 30 years, I'd say, great. Don't give me as much capital as you may have to give me based on the allocation. Give me half of that. Let me prove myself to you so that the relationship can go the distance 25 years. Because, in our first fund, the GP was 33% of the capital. And in the second fund, now it's 10%. So we do have a lot of our own skin in the game. And we chose not to take institutional capital in the first fund because we wanted to prove out that, pattern matching worked for both sides of the GP and the LP side. And I find sometimes, as a GP, you're trying to convince an LP to invest in the fund. And if they don't have the curiosity maybe to think about what you're trying to build, or they don't believe in it, then it's just not a match. And you should just move on and find someone that does. It's the same thing with founders trying to find a lead for their round. You talk to 300 funds, eventually they'll find someone that believes in what you're building. It's the same thing, I think, with the LPs. It sucks, but it's kind of the way it goes, right?
Yeah, absolutely. Absolutely. And look, I think it's a good point that you make around some of the decisions. These are hard decisions to take less money or try to accept less money than you might otherwise get. But looking at the long term is everything. And I know it's tough. When you're raising a $10 million fund, you're making $250,000 in management fees or even less in some cases. You're really thinking about here and now, how do I execute right now? But that doesn't mean you have to ignore the fact that you're building a long-term company, not just a single investment vehicle.
Yeah, I mean, people asked me when I was launching the first fund, like, are you ready to do this for the next 25 years? And my answer was absolutely yes. I absolutely love it. And in fact, all the management fees that we've gotten for our first fund and second fund, they've gone to my team. Haven't taken a salary in 2 years, going to be almost 3 years, but it's because of that long-term vision that our LPs were so supportive of us in both our first and second fund. So at Ripple, we've built a fund and showcased our ability to lead 80% of our deals. How do LPs view funds who focus on ownership and leading rounds versus funds who mostly co-invest with top tier firms but are not focused on ownership at the early stage?
It varies. So, I'll make a general statement. The more sophisticated or institutional LPs generally like investors that can lead rounds. They want people to have conviction on their own basis without having to rely on other people to either bring them in, or, people that may just be viewed as co-investing and momentum investors that sometimes face adverse selection, right? If other VCs are inviting you into their deals. Now, I do think that you can make money in a lot of different ways. And there's different extremes. There's the small concentrated approach where I take a bunch of ownership, early. I invest in 18 to 25 companies. And then you have the other side, which is more, let's call it the SV Angel, the 500 startups model. There's merit to both sides, but I think it goes back to having self-awareness of what is your zone of genius. And do you have an ability to run a concentrated portfolio where you can lead these rounds because you have something special that you're offering these founders, and you have deep domain expertise that allows you to take more risk because you are taking risk with a smaller portfolio. If you look at the math, very few companies reach $1 billion outcome. It's almost impossible to get to a 3x net fund without having at least one company that's $1 billion outcome. Just very, very rare to do. Ownership, of course, is really important, and because it just plays into the math. It's just a math thing. You can have smaller outcomes, and the average outcome still is about $70 million, which people forget. And if you own more of the company, obviously it's easier to get to that, fund returner. But you got to be sure, right? Like in your case, you have a specific thesis around a specific type of company in a sector, right? And from that perspective, your view is like, I can lead deals because I understand it. I have a conviction to lead deals, and as everyone knows, the most money is made when you're betting against the crowd, or not with the crowd, with everyone else. And you're right. Now it's hard to do, and that's why a lot of people do go to 30 to 40 to 50 companies with lower ownership. And I think that's okay at seed. I think at Series A and Series B, that's probably not the right model. But overall, look, I've never been dogmatic about a single view and saying, okay, you have to do this a single way. But I will tell you, from an LP perspective, there is an inclination toward people that can lead deals.
Makes sense. Your answer is it depends. And diversification works for you and against you. Obviously, on a concentrated portfolio that you're leading, you need to have some pretty big winners to make sure it covers the fund. But then, as we had Elizabeth on our podcast and as well on yours, she comes from a background of investing in 500 plus startups. And so at Hustle, it makes perfect sense why they can write so many small checks, because they've had the ability to manage that type of pipeline of companies and watch their winners take away from the rest of the pack. At Ripple, we decided to lead because we wanted to be really close to our founders, have the ear of them, be on the board, and help build the right structure around them from the early days, especially in our first fund when we really didn't even have a brand or a platform to leverage. We wanted to be able to build that alongside of our founders. And so you're right. It just depends on what works best for you. But as long as you can demonstrate that's where you've come from and that's where you're going, and not have a mixed bag of both of them, it's probably the best thing to do, right?
Let's just go through the math of venture capital. Let's take a $50 million fund to get to a 3x net, which is what LPs generally expect out of investing in an early stage fund. You have to get to a 3.5x net. That's assuming a 20% carry hurdle. For a $50 million fund, that means $175 million in distributions going into the fund to get to that 3x. And in that scenario, if you own 10% because you're leading deals and you get diluted down to, let's say, 5 at exit, it's $3.5 billion. On the other hand, if you're not leading deals and let's say you own 4% at the initial investment, you get diluted down to 2, you're looking at something that's more like 7 billion plus in value that you need to derive out of the portfolio. That's really, really tough to get $7 billion in enterprise value. And in those cases, you have to have more companies, right? So, I just think that if you know what you're going to do, you have to understand the math. And there's so many times I have conversations with managers that don't get to what is the enterprise value needed to return a 3x, right? Like, what exactly is that? And if someone comes to an LP and says, okay, we're going to do 20 deals, we're going to own 4%, the LP is going to do the math and say, what is that path? I mean, you're really looking for moonshots. What is the probability of getting a moonshot? And how large does that ultimate winner need to be to get me 3x money, right? And so these are just mathematical examples that I just think that people should always go through before pitching LPs.
Yeah, I couldn't agree more. I mean, we run the models on our funds to the T, and it's something that, we set out to do in our first fund, and we did in our second fund, and we came out with our first fund at a $400 million enterprise value for us to get 3 to 5x. And that's because on our early pre-seed companies, we own, 15 to 20% going into a seed, and our average ownership was close to 10% across the portfolio of 10 companies. So, the concentration is working for those types of investments when you can get that ownership. But it is amazing how many funds don't really build that model out to see what companies need to exit for, how many rounds of dilution are you going to take, and where are you going to end up at the final round before an exit. And these are all assumptions. Nobody knows the future, but at least try to do the math to make sure, like, worst case scenario, I need to get to X, hundreds or billions of enterprise value to know I can even achieve that 4 or 5x return in the fund. So I love, talking about building a venture fund versus a venture franchise. And you've discussed how GPs should have a mission statement similar to startups that exemplify the need to build a long-standing business and not just an investment vehicle. How should emerging managers think about building a differentiated mission statement when there are thousands of funds already in the market today?
I don't know that it has to be differentiated on the mission statement itself, but the mission statement should be very clear for the reason for existence for that manager. Why do you exist? What are you looking to do with your firm? What is your product? And all of those should be encompassed somewhere in that mission statement in a very clear way. I don't know that you're going to be able to differentiate just on the basis of mission statement, right? It's like, at the end of the day, venture funds, run a business that I don't know that you can actually be truly differentiated just based on a single statement, but it should encompass exactly why you exist.
I gotcha. So you're trying to basically say, like, it starts with a statement, but that isn't the only thing, but it should trickle down into all the quantitative and qualitative things that you're building at the firm. And so it's not like, think about, hey, I'm doing this for the financial gain, obviously. It needs to be more than that. There needs to be more substance so that an LP can make that 30-year bet essentially on you.
Yeah, and I also think that it should represent the true north for as you make decisions, something that you and the rest of the team members or anyone associated with the firm can point to and say, this is how, let's not forget why we're here, all right? This is what we're trying to do. And whether it's a qualitative decision, a quantitative decision, an investing decision, a relationship question, it should all point back and be consistent with that mission statement.
Yeah, absolutely. I mean, that's why we call it the ripple effect, but each one should have their own. So you've discussed how micro VCs often struggle to take advantage of the valuable pro rata rights in future rounds of their most promising portfolio companies, given the rise in need for SPVs. How do institutional firms view SPVs as it relates to overall fund performance? And are you a supporter of them?
Like anything else, I think it depends. SPVs are very GP friendly, especially when there's economics tied to them. The reality is most early stage proof of concept funds are going to have to use SPVs. The fund sizes are at a point where you really can't have a great reserve strategy if you're raising $15 or $20 million. I do advocate that taking as much ownership early in your portfolio construction makes sense in those cases. And then looking at the Series A and B, in some cases the Series B, and offering it to your LPs is a good thing, right? And more and more family offices want direct access, and SPVs are a way to do it. Over time, as an institutional investor, people will look at that and say, no, I'd rather have you just raise your fund size and exercise good portfolio construction discipline and do those pro ratas through the fund, because not every LP is going to go into every single SPV. And therefore, you're going to have a lot of LPs, especially institutional ones, that are invested in the fund that don't get the benefit of any of the upside on the SPVs. Now, you can be creative. You can have LPs go directly into them. You can raise your fund size, or you could do something like Tribe Capital does and Ted Maidenberg and team. What they do is they use SPVs very heavily. They have a program called First Look, and the carry from those SPVs actually goes into the main fund to create alignment with your LPs. Generally speaking, I think, showing that you can get pro rata into those really, hard to get into companies is really important, as you go from a fund one to fund two. What a lot of LPs are going to look for is, does this manager actually have the ability to retain their pro rata or even do super pro rata? And in some way that implies, has the manager built relationships with those follow-on investors? And do they have founders that are pounding the table for them to stay into that next round of capital? So in that case, I'm all for SPVs. I think it's something that you should do. Now, the caveat is it's really tough to execute the SPV strategy, because while a lot of family offices want it, moving quick enough to actually do a deal is really tough, especially at the early stage. So I find SPVs generally work really, really well in that Series B and later. But when it's a C deal, a Series A deal, oftentimes you pass the hat around and it's just you don't get enough bites in the time allotted to actually do the round. But over time, I think, LPs are going to raise a bigger fund, put more reserves. If you want at some point, there's much more amenability to opportunity funds, right? So, and those come with different economics. But I don't think I'm opposed to SPVs. I just want to understand exactly, are SPVs a long-term strategy? What are the economics underneath that? And how are you going to execute and reduce conflicts of interest between what goes in the fund and what goes in the SPVs?
Yeah, for sure. Again, it definitely makes sense what you're saying, as long as you've executed on your, ownership targets and your reserve strategies, and then you have the ability to get pro rata rights going forward. SPVs makes perfect sense. For us, we've done a handful of them on the Series A companies that we've gotten to Series A, and we're instrumental in getting those lead investors to the table, that we've gotten super pro rata on all of our SPVs, which is, again, helping show the value we bring in return for the SPV ownership we get to offer. And we've been very fortunate to have very supportive LPs and be oversubscribed on all of our SPVs that we've raised for our companies. But again, as maybe the funds get larger at the initial fund, maybe SPVs don't make the most sense for institutional LPs, so they can look to go direct instead. But that makes perfect sense.
I think the main thing, though, Matt, is understanding that your main product is the fund family, right? Your main core funds, and making sure that when you're doing these SPVs, managers don't forget that, and you're very defensible in why you made certain decisions. The last thing you want are institutional LPs that look at your non-institutional fund and see this separation between the main fund and SPVs and ask, you had the ability to do the full pro rata out of the fund. Why did you do that at the SPV? And the thought there would be like, are you just trying to maximize your carry on a deal by deal basis? And you just don't want those type of questions, right? It has to be defensible and very consistent in how you employ the SPV strategy if you do it.
Yeah, for sure. And I think, having an open dialogue with LPs as well throughout the process is really important. So that makes perfect sense. Thanks for sharing that. So you've recently launched your own podcast called Venture Unlocked, designed to educate and assist emerging managers and aspiring investors with the information and tools necessary to drive smart, diverse, and informed capital to entrepreneurs. After creating such a popular and engaging blog series, PEVCbanker.com, what made you want to launch a podcast series yourself?
Yeah, it's something that I've been procrastinating on for a few years. And it all goes back to when I started at FRB, First Republic, in 2012. Our thesis was not only to work with emerging funds, but help them through all aspects of firm building, from fundraising to operations. And we just felt like it was a black box. I mean, there's so many managers coming to market. You don't know what you don't know. And what happens is you end up spending a disproportionate time on things that are not investing. And a lot of that's because you don't know where to go to. There's not a lot of great sources of information. I think that's changed over time. And, there's great people like Operator for Capital recently did something to help emerging managers. But we are in this really interesting spot that, I talk to LPs and GPs every single day, and I wanted to synthesize that information in a way that was easily consumable by people that are starting funds, entrepreneurs that are trying to understand the venture business, and for LPs to hear from each other and from other GPs on how the venture business actually works. So the strategy for the podcast is very simple. It's focused on building a great firm, like what goes into it. As we've talked about in the past, 30, 40 minutes here, it's about building a company, right? I am focused on like all the things that go into building a company that just happens to be an investment firm, and making sure that we leverage such great insights from the people that we have on the show, who are, by the way, more than willing and gracious to share their insights. And so I'm really excited. It's, I have it on Substack, so ventureunlock.substack.com. It's on iTunes. And I've actually moved all my blogging to either Substack or Medium over the last year.
Yeah, it's absolutely incredible. I know you're about 6 episodes in. I've listened to all of them. They are truly well done, concise, and really professional. And I've enjoyed them. And your blog, pevcbanker.com, was also a great read over the years. So thank you for all the content that you've been putting out there. So I'd love to move to my favorite part of the talk, which are your book recommendations. And you have 4 amazing books here. Can you tell us about each one of these and why our audience should give them a read?
Yeah, each one's a little bit different. I mean, I think most people have read Blink or understand, the concept of Blink. It's probably, I'm a big Malcolm Gladwell fan anyway, so I really do enjoy the book, but it really goes to how people make decisions. And, we've talked a little bit about pattern recognition, gut reactions to things. So I really like things that have to do with psychology. And Blink, in a lot of ways, gives you a sense of how people think. The Advantage is a book that really talks about organizational health. So many organizations fail because the health over time atrophies. And I always look at companies as an organism that, left unchecked, will have cancerous cells, right? You want an organism to be healthy at all times. And Patrick Lencioni, who wrote The Advantage, really talks about the different components of building a real long-term organization that is built on certain principles. And so for me, that was a must read when I joined, after being started building the group that we have here. The success equation goes to skill and luck. Venture is skill and luck, right? Like, the reality is you can be the most skillful, the smartest VC in the entire world and have shitty returns. I mean, that's just the reality. You do need this component of luck. But understanding how those two play together is really important, and understanding that, luck is something that, venture is also a business in long sample sizes. I feel like skill does become more and more important, and it's more and more apparent. Small, like if you do 10 deals, the worst VC in the world might outperform the best VC. But over 1,000 deals, over 100 deals, the outcomes are going to much more lean to skill. So from my standpoint, it's, you can control the skill, you can help optimize on the luck that when it does occur. But the book really speaks to, skill and luck, and it goes through a whole variety of type of examples. And the final one is the Phil Jackson book. And again, human psychology. Phil was one of the most successful basketball coaches of all time, won multiple championships with both the Bulls and Lakers, and managed some monstrous personalities with big egos. In our industry, and in any industry where people are successful, managing people and managing personalities is as important as anything else. And so I love just seeing, and I'm a big sports fan as in general, I love it. And I'm a Laker fan. So of course, Phil Jackson is very near and dear to my heart, but having him walk through how he managed, like, the type of personalities, how does he keep things together, was so interesting for me.
Yeah, taming those wild horses, as you've seen probably the videos of him trying to explain it like that, is absolutely incredible to see. Well, these are great books. Thank you so much for sharing them with the audience. Before we wrap things up, we always ask our guests for any final words of inspiration.
I really think that right now we are in the best place possible. And I know it's very strange to say, because there is a dichotomy in the US between, what we do, which is technology, venture capital, and really Main Street. And, that part really worries me. But I do feel like, from a technology and investing standpoint, we have the opportunity to make real change, to make the lives better for not only people that live within the sector, but people that are on Main Street, that are in other countries. And so I'm so excited about things like, climate, investing. I'm really excited about, underrepresented. And I do think the next decade will show a lot more of that, value that comes out in ways that actually matter to not the 1%, but to the 99%. It's going to take some time, but I can see it. And, this is the first time I've had the feeling the way I do right now. And it's based on all the conversations I'm having. So if you're an emerging manager starting a fund, I think it's a great time to do so. If you're a company, starting on something based on a problem that exists that hasn't been solved, but is solving for a large mass of people, it's a great time to do it. Yes, we are in a weird place, and we'll get through it like everything else. We're a resilient group, but I'm just so very fortunate to be where I'm at. And my role really is pretty simple in helping these people that are doing really exciting and compelling things, reduce the friction of doing so. So I'm psyched. I mean, like, you could probably tell that, but those are my words. Just if you're out there and you want to do something, go build right now.
Yeah, that's amazing. And I couldn't agree more. There's a lot of scary things going on in our world, especially in the year 2020, but there's a lot of hope and there's a lot of walls and barriers being broken down. And I think technology is helping lead the way for a lot of the underrepresented people to get access to a lot of the things that can change their lives and the future generations' lives for a long years to come. So thank you so much for joining me in the tank today, Samir. I really appreciate you sharing your story and your thoughts on how emerging managers can break through the crowd.
Yeah, thanks for having me, Matt. This is fun.